Will USDC become the United States central bank digital currency? This is a question that has come up and been discussed for some time, and I wanted to share what I have learned and my predictions. Hey, welcome to the show. I'm Molly Elmore. Today we're going to talk some more about CBDCs. This is one of my areas of interest as this channel is focused on trying to figure out the future of money. And it is a pretty common topic of conversation in the last couple of months, if not the last couple of years, about whether we're going to move to this sort of blockchain money, central bank digital currencies, which get abbreviated CBDCs. And there's a lot of kind of concern and fear around this topic, and I totally relate. For the last couple of years, I've had this belief that the sort of CBDC concept is dystopian and it's a control mechanism and that it's not something that we want. However, like most things related to geopolitics or even finance, it's not really that simple. And I've really kind of come around as I've dug deep into this issue. And I actually am now not very concerned about CBDCs. And I'm going to explain to you why right now. If you watched my previous video about CBDCs, which I will link in the description, there are multiple types because this concept of a central bank, which we have many in the world, issuing a currency is not a new idea. And there are different ways that banks send money to other banks and banks send money to people. So there isn't just like one concept here. And that was, I think, the hang up that I had initially with understanding CBDCs, and other people have as well. First lesson is there is not one kind. Second lesson is there are two broad categories. One is wholesale CBDC, which is generally a unit of value that a bank uses to send money to another bank. It's kind of like if you've ever had an e-commerce store or had a retail store, you kind of purchase things on the wholesale market, and then consumers buy things on the retail market. So there's also this world around retail CBDCs. And actually, after I did my last video about this and did something on Twitter, I've since realized that like within the wholesale and retail, there are also some additional layers of how the value gets sort of disseminated through the banking world. Because if you kind of think about this hierarchy, you have a central bank at the top in the current model. Central bank at the top in the US, it's the Fed. In Europe, it's the ECB. In England, it's the Bank of England, the UK. Then there are all these commercial banks, and these are the banks where we as citizens go and have an account. Wells Fargo, Citibank, there's tons of them. Some of them are large international banks. You could also have an account with your local credit union or a regional bank. Like there's tons of banks. And so the idea that seemed strange to me when I first really dug into this is like, if we now all of a sudden had an account with the central bank, what do the commercial banks do? And this is where I've really come full circle. And if you watch any of my videos about sort of the Tom Luongo thesis about Davos versus the Fed, it all kind of relates to this, that there's sort of a faction in the global cartel based in Europe, these sort of old school European colonial oligarchy, wealthy people who would like a return to feudalism. We're not fans of this. Part of their plan is to centralize the money out of their region, probably with the IMF. We would all use this one currency. The money would be issued from this central bank, and it's sort of where this like one world government, one world currency idea comes from. The problem with that goal of theirs is that it screws over a whole lot of other people, including very wealthy, powerful people who own multinational banks, who are like, yeah, I don't really want to get cut out of the flow of money because that's how my business makes money and that's where my source of power is. So the idea of a CBDC gets a little more complicated when you get into the details of like logistically, how would this work? And the more I've gone through the logistics of this, the more I realize, like, I don't actually think much is going to change between what we have now and what is likely to happen as our sort of monetary system moves to the blockchain. I'm going to break down for you some charts that I have from some research. These are pretty much official charts from, like, I think these were from the BIS, the Bank of International Settlements, which is the central bank of central banks. Now, the BIS, they have a very strange setup for themselves. They have sovereign immunity. Like, they literally are above the law. They kind of do whatever they want. There's a lot of secrecy around the BIS. What is kind of refreshing is that they do release a lot of papers that are very dry to read, but they share a lot of pretty interesting insight about what the plan is. And the more I've dug into actual bank-related documentation, the more I've seen that, like, no large Western country appears to have a plan to issue the currency directly from the central bank to the people. That would be called the direct CBDC, where me as citizen has an account with the central bank. They issue the money directly to me, and commercial banks have no idea what to do with themselves. That is sort of the dystopian concern. In my previous video, when I kind of showed you all these, like, worst case things where, there's rationing of your food and all this stuff, that we don't want that. I don't think that's going to happen in many places. There are some exceptions, which I'll talk about in a second. But for the most part, when I approached this as an American, I initially wanted to know, like, my region, because I understand the banking system here a little bit better than in other places. So for the US, it's very unlikely we're going to get what's called a direct CBDC, which is where we would have an account with the Fed and we would get money directly from them. And the reason why I'm confident of that is, number one, the Fed just tweeted that people in the United States do not have accounts with the Fed and will not. Danielle DiMartino Booth, who is a Fed insider, has written books about the Fed, worked at the Dallas Fed, has very bluntly stated, we will not have a retail CBDC, which is a direct CBDC in the US, because the commercial banks don't want it and they're very influential. Does that mean that we would never? Now, here's my third data point. I have a friend who is president of a bank down in Florida, smaller regional bank. And when I first learned about CBDCs, I asked her, like, as a smaller bank who's not like a Fed member, are you open to this idea? Because it's going to cut you out of the flow of money. And she was like, I'm not worried about it. It's not going to happen. And I was like, but how do you know? I've read this on the internet. And she's like, don't worry about it. She said, not in our lifetime. Maybe in, 50, 100 years. But she's like, it's not going to happen. And I didn't really understand exactly why at that point, because I wasn't really thinking about incentives, which is so key to understanding how all this stuff works. There is no incentive for the commercial banks in the US to support getting cut out of the flow of money. All right, then so that said, though, there are benefits to blockchain technology. You can move value really fast. It's very inexpensive. A lot of arrangements that are currently set up using correspondent banks are a pain. Like, they require banks to set up accounts in other banks called Nostro Vostro accounts. I did cover this in a previous video. I'm not sure I can remember which one, but I have a thread on correspondent banking that I will put in the description. But right now, when you send money to somebody else in another country, no one can actually send money. They just have money sitting over there waiting to be debited for that transaction. So there's all this money sitting around waiting for a transaction to maybe happen in, like, every country, into most countries. So it's a ton of waste for these banks to have this money sit there doing nothing when it could be used in more productive ways. So then there are some sort of modified scenarios, I guess you could call them, for CBDCs. So we decided that the direct CBDC has a lot of drawbacks, namely the commercial banks get cut out. So there are some other alternatives called a hybrid CBDC, an intermediated CBDC, and a CBDC-backed stablecoin. We're going to talk a little bit about these, but I will give you a spoiler that I think it's very likely in the US we will see what is called a CBDC-backed stablecoin, which, to be honest, is not that much different than what we have in our current banking system. All right, it might be hard for you to see this visual, so I will describe it in case you're also just listening to the audio. So a single tier retail CBDC is the simplistic model that people are scared of, that I've been scared of, because it has this dystopian scenario where all of the money is controlled at one entity, and it potentially could have a smart contract that programs in logic. And we don't know who would control that smart contract. It could be used for political reasons. It could be used to silence dissent or to restrict your ability to do stuff like go places and buy things or whatever. And in that model, the central bank issues the money, and there isn't really a commercial bank. They're just not involved. This is least likely, I think, to happen. Now, in the U.S., this could happen in Europe simply because the ECB seems to want this. They are part of this Davos crowd. I have seen some legislation or press releases, I guess you call them, about some rules that would talk about limiting transactions. The central bank digital currency in Nigeria seems to be this model. And I did just speak to somebody in India, and that also appears to be this model. So there are places in the world where this direct CBDC may go into place, and it doesn't involve using banks. Now, don't quote me on those other places. I don't have tons of insight into those, but just when I say I don't think this is going to happen in the US, I don't want to incorrectly lead you to believe that it wouldn't happen anywhere. At this point, I just have been very hyper-focused on the US commercial banks and their reaction to it. Now, the truth, though, is that if this doesn't happen in the US, but it happens somewhere else, and it's sort of another Western country, especially an English-speaking country where those people have a lot of friends and relatives in the US, if that system sucks and we have something different, that's going to be a problem for the place with the system that sucks. So just know that this idea of sort of centralized, controllable, programmable money, I think they've got one shot to use it everywhere, or it's not going to work. It's not something really that you can selectively implement because people will revolt when they hear about this. They don't even have this system in China of centralized money. All right, we're going to talk about some of the other scenarios, which is what they do have in China, as well as what I expect there to be in the US. So the other scenarios, hybrid, intermediate, and the stablecoin one, they all include the commercial banks. So right off the gate, we know that the commercial banks would be more likely to employ this one. And the difference really has to do with, I think, the way the payments are done. So in the hybrid CBDC, the money is issued by the central bank, which they call that being a claim on the central bank. Then the intermediaries, which would be the commercial bank, will do the onboarding, meaning you have an account with a commercial bank, just like now. You have to give them your license and fill out paperwork to verify your identity. And they would handle the retail payments. So if I went to go pay a bill through my bill pay, then that goes through the commercial bank, just like now. The central bank periodically records retail balances. So this now is between the central bank and the commercial bank, how they're keeping track of things and sort of their accounting mechanism, which as end users doesn't really affect us that much. Then the intermediated CBDC, again, the value is created by the central bank, which is basically what the reserves are that the Fed creates now. The intermediaries onboard the client, same deal, meaning you have an account with your commercial bank. And that commercial bank executes retail payments, just like now. If I use bill pay, it goes through my commercial bank. And the central bank processes wholesale payments. So this has to do with when a bank sends money to another bank. So this event would involve the central bank for, again, this is kind of back-end transactional stuff that doesn't really affect us. It's kind of maybe interesting to know, but for our sort of viewpoint as an end user, there doesn't seem to be much difference between the hybrid and the intermediary for the end consumer. Then there is this fourth option, which we're calling, they didn't label it on here. I think this is the reserved stablecoin. So a CBDC backed stablecoin. The CBDC is backed with reserves, which is value issued by the central bank. which now it could be fiat like we have now, or central banks could move to a system where they issue value based on assets. This is kind of what the BRICS nations have talked about, where instead of just printing the value out of thin air, they're like, hey, well, we got $1 billion of gold. We're going to issue $1 billion worth of reserves to correspond to the gold. So how these CBDCs are backed is like a separate topic for a different day. I've been more focused on whether or not a CBDC that we could feel like is retail is actually not that big of a deal, meaning it goes through the commercial bank. And the reason why this is important, having the commercial banks involved, is that there are many commercial banks. Okay. That is good for us because if one commercial bank sucks, you can leave and go and have an account with another commercial bank. Competition helps keep things in check because when you have choice, nobody wants to be the bad guy because, or the only bad guy, because then you'll leave and go have an account with somewhere else. I mean, this is sort of like the problem that PayPal had recently. Some bad PR came out that they were sort of censoring or fining you actually $2,500 if you did something they didn't like. They had some very vague, like hate speech definition in their terms of service. So if you were a seller on PayPal and somehow PayPal found out that you had talked about one of their taboo topics, they could fine you $2,500. So that made a lot of people mad. And so guess what? They shut down their PayPal account and they went to a different processor. And so when you have choice, there's pressure on these entities to not act like jerks. That is why the CBDC, if it were the direct one, that would be scary because there's only one central bank in each country. You can't switch. But in these models that we're talking about now, where the central commercial banks are involved, we have a choice. I mean, as far as I know, I've not seen anything that would indicate you are not allowed to work with a variety or, whichever commercial bank that you want, just like you have now. All right. So the difference, though, with this model is that the central bank would issue reserves. They would give these reserves to the commercial bank, which could then issue you a stablecoin. So this is kind of moving towards a model where there's more assets backing the value. And if a commercial bank sends bank one $100 million in reserves, then that bank can now issue $100 million worth of digital dollars, stable coins, to their people. This includes loans. Now, there's one thing I'm still working to figure out is whether or not this would mean the end of fractional reserve banking. I'm not fully convinced on that, but it would make it more transparent because you would know via the blockchain how many assets were issued. Whether that would be available to us as end consumers, not likely. But then the banks would at least know that. Okay. So then I've said, you know what? Let's go to some of the Fed sources. Now, the Fed has actually 12 branches, I guess you call them, 12 regional banks, and they all do a fair amount of research. And so I found a paper from, I think last year, from the Richmond Fed that talked about this idea that they were recommending regulated stablecoins. So that's interesting that the Fed, who would be the issuer of the stablecoin, of the CBDC, is actually advocating for a model where they have less control. This is important because it dispels this belief that the Fed is like this power-hungry entity that wants all the control. While that might be an easy conclusion to make, think about all the logistics involved in actually controlling the money at that level of detail. You as the Fed now, you have a pretty sweet gig. You have a couple hundred banks that you have accounts with you, and you send them value and you control interest rates and do a bunch of research. I'm very much simplifying what the Fed does. But if you were to change that now and say, okay, now every single American is going to have an account with us, and we're going to have to monitor their transactions and keep track of their social credit scores, like that's a ton of work. You need a really impressive database. And now you're going to have to hire all these people. That's a big deal to take that on. And I don't see there being any upside for the Fed to do that. So this Richmond article is basically advocating, instead of a direct CBDC, they are advocating for regulated stablecoins. Because remember from some other videos about the Davos Fed thing, the Fed has a product, the dollar. They care about the dollar. They want the dollar to be strong. They want the dollar to be a good store of value. They don't like inflation, even though there's this belief of money printer go burr. Sometimes that is often driven by the government telling the Fed to do things. And the Fed is owned by a bunch of commercial banks who want to have a thriving economy so that people buy houses and buy cars and put money on credit cards so that the banks make money. So the regulated stablecoin idea serves banks better, commercial banks, and the Fed actually works for the commercial banks. They're owned by that. So it's not a shock when you think about it that way, that this recommendation, which has been also reiterated by Powell, who's sort of the chair of the Fed right now, that they don't want to be the issuer of the direct-to-consumer CBDC. All right, so let's talk a little bit about what the Richmond Fed has said. Their main recommendation to Congress regulation should include, number one, require stablecoin issuers to be insured depository institutions. All right, so the other thing that the Fed does, and this was the original mandate of the Fed, is the Fed was created by a small group of banks that wanted to keep it in the family. They wanted to make a system that was not welcoming to outsiders so that they only had to share the market share with each other. One of the ways that they do this is through this idea of FDIC insurance, and that if you want to be a bank and be a licensed bank and have savings accounts and deposits from your consumers, you want to offer FDIC insurance. And it's not that easy to become a bank that's licensed and able to offer that. So it's a way they can keep newcomers out. A lot of regulation is about protecting the incumbent. It is not unique to banking. Lots of industries do this. So this is sort of the gig, that if stablecoins become the new way that value is sent via the internet, essentially, that's awesome. But they don't want anybody and their mother to be able to create a stablecoin, especially if it is a US dollar stablecoin. Their goal is that only they can do it. Then they have a monopoly on it. And the way they protect that monopoly is to require you to have some kind of license. And they make that process to get the license extremely difficult. And this ties into being FDIC insured and some sort of licensed stablecoin issuer. So that means that there won't be, 100 banks that, actually, I don't know how many banks there are that have FDIC insurance. It won't be every bank. It'll just be a small list. I actually think it'll probably be even smaller than all the FDIC insured people, that it will be sort of the more major ones who have influence with the Fed. They want to give flexibility to regulators to impose restrictions on wallet providers, a form of custody or digital assets. So they don't want some random MetaMask, which is actually JP Morgan owned, but some other new wallet to come along and now be a threat. Like, they want to own the rails and they want to own the software, and so they're going to restrict what type of wallet would work. They want to promote interoperability among stablecoins and other measures to prevent market concentration and potentially restrict data collection. So interoperability is great because if there was multiple stablecoins issued, you want people to be able to pay each other with different ones. Okay. They're also recommending two-tiered system of stablecoins. And this is, I found this very interesting. So one tier is backed 100% by deposits or reserves at the Fed. So, and this is referred to as a synthetic CBDC. The second tier is backed by a mix of liquid and safe assets. So this is, I think, how they're going to keep fractional reserve lending going. Fractional reserve lending is when you lend more money than you have. But you could have assets that aren't money, but have value that you use to generate. So let's say, for example, a bank owns a giant commercial building, like a skyscraper. And this skyscraper is worth $100 million. Well, it's not money. I can't buy anything with a skyscraper. But I could use that as collateral to issue $100 million worth of money that I could then loan out. that asset is still an asset. It would, in theory, hold its value. So this is kind of how these banks can, again, accumulate these assets to generate, is used to sort of mint the money. This again ties back to what we've seen with the BRICS reserve currency, where in that instance, there would be 20 different assets, which I took primarily to be gold, silver, oil, commodities, and potentially currency that are used now to back the currency. So it looks like we're kind of moving away from this credit model where money is an IOU to being money that is more asset backed, which is a good thing because the IOU model, it can get out of hand. You can issue so many IOUs, essentially your word isn't good for much anymore. Now they had this idea though of a synthetic CBDC, which I want to explain. I refer to stablecoins backed by reserves as synthetic CBDC because the term synthetic in finance refers to a combination of assets that pays the exact return of another asset. For example, a synthetic bond, XYZ, can be created by buying a risk-free bond and selling a credit swap on a bond, XYZ. Thus, the stablecoin is a synthetic CBDC because it's fully backed by reserves and can be redeemed as such. So it seems like they're allowing a variety of different assets to back the currency. So there's flexibility there. You could have physical assets that are difficult to sell, like that skyscraper. I don't know if real estate will be included. I'm just speculating. But things like gold, absolutely, I think would be included. Potentially, I don't know about silver. I mean, silver people are go back and forth about whether banks treat silver all that seriously, but other valued assets would definitely be a part of this. And when they're talking about liquid and safe assets, that also could include bonds, treasuries. Okay, so my next question that I've been trying to answer is whether or not fractional reserve lending will still exist, because that's how the banks make money now. So I have a hard time believing that they're going to move us to a new system where they can't lend out more money than they have. And that's where I kind of got there a little bit on that last slide where they can use assets to back it. But I have some more detail on here. All right. That said, a two-tiered system directly acknowledges that regulation would create a framework for synthetic CBDCs and allow for further simplification of regulatory requirements for institutions issuing only stablecoins backed 100% by reserves. It would also preserve the ability of issuers to create stablecoins not fully backed by reserves. That would naturally be the case, for example, for stablecoins not pegged to the US dollar. So I found this interesting because this is the Richmond Fed. They're not going to issue a stablecoin that's like a euro or another country's currency. So I did find it interesting, though, that they're talking about stablecoins pegged to something other than the dollar. So that was just interesting to me. But it did say that they want to preserve the ability of the issuers to create stablecoins not fully backed. So there will be fractional reserve lending. Whether it will be more difficult or at a smaller scale, I'm not exactly sure. All right, the second point to consider is that the regulatory requirements for depository institutions whose business models revolve around stablecoins may not need to be so severe. So I think this is addressing Circle. Circle is an issuer of stablecoins based, I think, in the US. They have some strong relationships with country Fidelity and BlackRock, and they claim that they only mint one token for every dollar held in reserve. So the idea, though, is that if they have this process that only allows that one-to-one minting, they might not need to sort of have this stringent reserve process. That's my interpretation of this. This is because, in contrast to regular banks operating on a fractional reserve regime, there is little risk and little maturity mismatch in providing only 100% backed stablecoins. In fact, overly strong regulations could pose their own risks by creating a barrier for entry and competition in the sector. So my takeaway on this is that if you wanted to be a non-bank and issue a US dollar stablecoin, there's a way to do it here as long as you are not creating new dollars. This ties back with the other Fed beliefs thesis that I've discussed in other videos. The Fed wants to control who gets to make new dollars. That's like their non-negotiable rule. So if you want to be a stablecoin issuer and you're not one of the banks that has the privilege of issuing new dollars, you can be a stablecoin issuer, but you have to back one-to-one with dollars. You cannot do fractional reserve lending unless you are one of the banks with this special license. So that way they'll look like they're open to competition, but really the fractional reserve thing is a walled garden. Okay. There's been chatter for quite some time about Circle's product, USDC, becoming the stablecoin. And I just saw this recently. It came up, like Coinbase CEO Brian Armstrong referenced it in a tweet thread. And I was like, wow, this keeps coming up, which is why I still have lots of flags about Tether. I don't see anybody ever discussing USDT being the US dollar stablecoin. But I see that for USDC. All right, so Circle had an interesting thing recently where they pulled their plans to go public, which sounded like a bad thing, like, oh, there must be a problem, there must be a reason why. I'm just kind of curious if it relates to this regulation. I don't know. It was just interesting that Circle still seems to be on the table for a stablecoin. They did also announce recently that they launched this thing called the Circle Reserve Fund, which is an SEC supervised government fund. So they're with the federal government, administered by BlackRock, that provides daily transparency onto the reserves backing USDC and independent oversight. So they're being incredibly transparent, unlike Tether, which confirms this idea that they are playing very, very well with the money side of the US government, which could put them in a position to have USDC be essentially the stable coin that banks issue. Kind of like a private, have you ever made a private label product where, you go to the CVS and you buy lotion, but it's like store brand? Well, CVS didn't actually make that lotion. They just put their logo on another product. So Circle's USDC could kind of become a private label type thing where banks issue their own version of it, but really in the background, it's all USDC. Again, some more things about this new product relating to BlackRock and this SEC money market fund. Now, there's another interesting connection that tie back to CBDCs, and that Stellar has a strong relationship with Circle. I don't think that the Stellar blockchains, like sort of the Stellar exchanges, have any other US stablecoin other than USDC. I've never seen USDT on there, or the older ones like DAI and UST, which isn't even a thing anymore. So it does kind of help me formulate this thesis that Stellar appears to have tackled the market of sort of bank to retail payments. They're more in the like PayPal type competitor, where I would use Circle's blockchain to send money to another person, or I could get paid by a company. Like my payroll could essentially come through Stellar's blockchain, and I could get paid in USDC, or I could pay you in USDC if I had to give you money for something, and it would all be built on the Stellar blockchain. Now, Stellar has quite a bit of documentation and videos and stuff about CBDCs. And at first I was sort of like, are they bad? Is Stellar bad because they're trying to get all these CBDCs? But then when I dig into it, they even have a graphic in their white paper that you can download from their site that, again, they're not advocating for the direct-to-consumer CBDC. They are pushing this model where the central bank issues value, but it goes to the commercial bank. And then the commercial bank is the one who distributes the money to people. So that is what Stellar is advocating as well. They even have it in text. A sample CBDC implementation on Stellar. This is a two-tier model for which many central banks have expressed a preference. A one-tier model in which the central bank distributes CBDC directly to consumers could be implemented on Stellar as well. But that's not what the banks are telling Stellar they want. They're saying you could do it, but this is the model that the banks want. There's also some more things here about that you could, what was this for? So this is how you mint on Stellar. Oh yeah, so this was kind of interesting. So you could mint the tokens on this Stellar, but then you have this sort of like separate account where they're distributed by. So again, it kind of shows this model that there's multiple steps in that the central bank is not minting and issuing directly to consumers, that it's going to involve the commercial banks. All right, to wrap this up, at this point in the US, because of the role of commercial banks and their power and their desire to not be eliminated, I don't see a direct CBDC being implemented here. I think we're going to have a system that uses stable coins that is not terribly different from our current model, where you have an account with your bank. If you don't like your bank, you can go to another bank. These banks who can issue stable coins will be limited, but that doesn't mean that if you have a local credit union and they don't have the ability to issue stable coins, you might use a stable coin issued from one of these regulated banks. We will be able to enjoy the benefits of blockchain payments, which means the transaction fees will be lower. So if you've ever wired money to somebody, you have to pay the $40. That could essentially go to zero. However, the banks could still charge us. We don't know that. We just know that the transaction fee would go away, and because there won't be any more correspondent banks who charge that money. We also could you could pay your bill and it could go very, very quickly. And it would reduce some risk on the side of payments where things don't go through in the current system. The thing that I would remember, especially in the US, is that the commercial banks are not going to support a big technology change that puts them out of business. Now, I think, though, in other countries, the banks may not have that same level of power. So I don't want to make this sound like this is a global conclusion. This is really just US based. I am closely watching what I see other central banks doing. The ECB and the Bank of England do appear to be going in that direction of direct, but it hasn't been implemented yet. So we will have to see how that works. Alrighty, if you like this video, please hit like below. Appreciate that. Subscribe to the channel. I'd love to have you join our community on Locals, where we talk about some more current event things. We do kind of weekly lives about what happened this week. I do give some more detailed point of views on things around investing and particular specific assets that I'm a fan of and holding. So love to see you in there. It's twostepsahead.locals.com. And I will see you in the next video. Take care.